price just went up $5. Okay, now imagine silver cartel. And you got some Chinese guy who's the director of the silver cartel. Comes out with a statement like, well, we're thinking about Mexico and Chile reducing by 10% their silver output. And the silver price goes up $2. This is potentially dynamite.
Just a basic equation. If the United States has all of the gold that we've claimed to have since the last audit in the 1950s, if we in fact do have all that gold and you divide it into $35 trillion of debt, if we had to pay our debt off with the supposed gold that we have, and I highly doubt we have all that, but assuming we do, the number would have to be over $125,000 an ounce. If you saw silver blowing out to the upside, that's going to drag gold along. That's going to light a fire under gold and thus destroy confidence in fiat currency. So the reason silver is the biggest redheaded stepchild in the history of financial markets is because it is the fuse to light gold on fire, and gold
be the time to show that chart I just sent you and to help really underscore what Billy was just saying. If you look at that chart, that's one of the slides from a presentation I'm giving this week. The red line represents the big 4 banks on COMEX that are short. The green line represents the top big 8 bullion banks. If you notice that there are 8 banks right now short, the largest concentrated short position on any commodity ever traded in the history of the COMEX market in silver. Now, why the hell would that happen? Of course, followed number 2, platinum, gold, palladium. So, the 4 precious metals that are monetary metals as much as anything are being suppressed by 8 banks. Is kryptonite to Western fiat currencies.
You told us also, Bill, here in your last interview with Greg Hunter on USA Watchdog, you were extrapolating whether or not we would back a currency by gold. You talked about different parameters, 10%, 20%, and 40%. And based on each of those parameters, what could be or should be the gold price to make all of that accounting work. Now, in this particular unit announcement here for September, they're talking about that 40% gold backing here. Can you explain to our audience what that means for the price of gold? Explain that, how you make those calculations, and then let's also extrapolate that to perhaps what's going to happen with silver. And I did hear Bill call that publicly. He said, I think it will be 40% gold. He said it. Right. He's like Absolutely. A soothsayer or something. You must be psychic. You want to do some readings on my show, Bill?
Well, before I get into that, I want to mention that the repatriation of gold really started back in 2013. And I did the math on it. If you remember, Germany wanted to repatriate 300 tons. And publicly, it was said, oh, well, there's no way we could do that. That's just too risky to ship that much. It's going to take us years, blah, blah, blah. And when Germany did get their gold, it was not the gold that they originally deposited. The serial numbers were off. And I mean, simple math, a 747 cargo plane can hold or can carry 95 tons. Yeah. So 95 tons divided, into 300 is 3 plane loads and a small one. They could have done it in 2 weeks, but they said, oh, no. And it didn't get finalized until 2017. Now, as far as the 40% backing, which I'm happy that it's that high. I thought it was possibly only going to be 20, 25%. But understand, look at the math on the amount of global trade that gets settled every day. And if it's going to get settled in this currency, man, that's a lot of gold. And guess what? At current prices, there's not enough gold. So they're going to have to revalue gold. Pick a number. I can't even really guess. 3-fold, 5-fold, 10-fold. Who knows where they're going to settle gold price-wise in order to make it valuable enough to basically settle 40% of global trade. It's a huge number, and the gold, like I said, at current prices, does not even exist.
So let's get back into that interview with Greg Hunter. You kind of gave some prices there. You referred to some of the older predictions also by your ex-partner, Jim Sinclair. Where do we see gold as a starting part here if we're backing it at 40%?
No idea. The math that I did for that interview, it was just a basic equation. If the United States has all of the gold that we've claimed to have since the last audit in the 1950s, if we in fact do have all that gold and you divide it into $35 trillion of debt, if we had to pay our debt off with the supposed gold that we have, and I highly doubt we have all that, but assuming we do, the number would have to be over $125,000 an ounce. Mm-hmm. Now, as far as a trade currency, I'd have to see exactly what the global trade is minus the West, but it wouldn't be completely minus the West, because if the West is trading with BRICS nations, then one would think that the Western nations would have to have these units in order to settle the trade. So they're going to have to go out, dump dollars, dump euros, dump yen, dump British pounds to create the capital to purchase these units. And of course, that's basically a bid directly underneath gold, because, probably the easiest way to purchase a unit would be with gold itself. I mean, how are you going to do it with 50, the other 60%, if it's going to be 50 different currencies? There's no way. That'd be like trying to herd cats. So you just go directly to the source, you buy gold, and basically what you've done is you've bought yourself, representative units, if you will.
What you said about silver, you were talking about the overhead resistance. Many people in these communities are talking about that $50 mark from the last all-time high. You're suggesting the overhead resistance is much lower than that perhaps maybe the weak hands have already been washed out here, given the time span between that last high. Explain that to the audience members. What do you mean by that?
Well, the last high was 50. And in between that move, I think we ran from $15 or $17 up to $50 in about a 6-month period of time in late 2010, first half of 2011. And, there was choppiness. It would, and I don't even know if these numbers are real or not. I'd have to actually look at a chart. But, we ran up to 20, 25, pulled back a little bit, ran up to 30, 35, pulled back a little bit, chopped at 40, and then we spiked up to 50. So on the way up, there were resistance levels. Mm-hmm. And on the way down, we bounced off of 44, we bounced off of 40, bounced off of 32 and 30, crashed through 30. Normally, those would be points to look at for support and resistance, but that's 11, 12 years ago, 13 years ago. So those are long gone, long forgotten. And I mean, the sellers at whatever level or the buyers at whatever level, they're all gone. So those are meaningless. Right. They're meaningless numbers. So, I mean, in reality, there's nothing to stop silver from going, we break through 32.50. There's nothing to stop it from going immediately to $50. Do I think it's going to happen, immediately? No, I think in a more normal market frame, it probably should take, 3 months, 6 months, and that would be a rip snorting bull market. But at some point in time, we're going to have a failure to deliver. We're going to have a massive short covering squeeze, and it very well could turn out that it works out like a light switch where $50 is meaningless and it blows right through $50 like it wasn't even there. My partner, Jim Sinclair, used to talk about the scenario where you could see gold, $50,000 bid, and COMEX contracts for gold, $10 offered and no bids. And the reasoning behind that is his question was, what is the value of a contract that cannot perform? Mm-hmm. And a failure to delivery is not performance. Right. So basically, you could have the contracts go to zero, and you could have gold basically unobtainable.
Mm-hmm. JC, now.
Good evening, investors. Buckle up, because we've got breaking news in the world of precious metals. Silver and gold markets are on the verge of seismic shifts that could radically reshape the financial landscape. In a recent interview, experts Bill Holter and Andy Schectman shared staggering insights about the future of silver and gold prices. Their analysis hinges on several key factors, but the main takeaway is this: silver could be the fuse that lights the fire under gold, with the potential to disrupt global markets and fiat currencies alike. Let's start with silver's role in the economy. It's not just a precious metal, it's a commodity with massive upside potential. With the current geopolitical climate and the looming economic instability, silver has become a tool for savvy investors. Holter suggests that silver's price, once it breaks through its current resistance levels, could skyrocket beyond $50 per ounce. He emphasizes that silver's market is so small that if it catches fire, the impact on gold prices will be profound. Why should you care? If silver starts climbing rapidly, it's going to drag gold along with it. This surge could trigger a loss of confidence in fiat currencies, as gold, often seen as the ultimate store of value, begins to reassert itself. In fact, Schectman and Holter believe that central banks' efforts to suppress precious metal prices, especially silver, are a desperate attempt to maintain faith in fiat systems. So, what's the number to watch? Holter calculates that if the US were to back 40% of its currency with gold, a number recently floated by global financial institutions, gold prices would need to jump to $125,000 per ounce to cover the $35 trillion debt. For silver, the potential is equally dramatic, with Holter predicting a price surge fueled by diminishing stock and skyrocketing demand from nations like India.
To a degree that the COMEX market has never, ever seen. And when you talk about the CFTC is supposed to protect against collusion, against price fixing, well, they're really doing a shitty job, because this is exactly what they're supposed to protect against. Silver is a small market. It is minuscule, the size of most of these other markets. And look at the concentrated short position of 4 and 8 big banks that are holding the price down. And what beats them at this game are countries like India, who are standing for delivery and took almost 700 million ounces from the West in the last 2.5 years. And then they just, because they have this deal with United Arab Emirates where they don't have to pay duties, last year in 2023, they did $2.2 million worth of silver imports from January to April. United Arab Emirates, India did from them. And now, over the same time frame this year, 1.44 billion worth of silver imported, a 654-fold increase. They're buying silver wherever they can. Mm-hmm. And they're using the suppression of these idiots right here, these 8 banks who are holding the price down, to reposition. And that is how they win. No one ever stood for delivery. It is how you win, because all of this selling right there, you're talking way more silver that is in contract form than they have the ability to deliver if called to the carpet. And this is how it all ends poorly. And when you see that chart, it should really explain a lot of things.
Bill, you're an authorized broker for Miles Franklin. What are you hearing right now in the last couple of weeks talking to clients? Are we seeing market jitters right now? I know a couple of years ago we had a big panic to own moment. You guys' phones were off the hook. It kind of died down with the premiums the last couple of months. But just now in the last couple of weeks, as we're seeing this huge turnaround here happening on the geopolitical front, what are you hearing? What are people telling you?
Yeah, up until a couple of weeks ago, I think, yes, it had slowed down somewhat. We're getting, and Andy can confirm this or deny it, but I think what we're seeing are less orders but bigger orders. The phones aren't ringing as much. I'm not getting as many emails. And I do think that North America as a whole, the demand is down, and that's the reason that you're seeing premiums back to where they were before COVID and basically normalized. And I do want to mention that chart that Andy had sent you and put up. You'll notice that the top four most heavily shorted are gold, silver, platinum, palladium. Platinum and palladium, not really precious metals, not really money. They're more industrial. Silver's a hybrid; it's industrial and money, and gold is money. The comment I want to make is you have to ask yourself why. Why is it that the metals themselves are more heavily shorted than anything else? And I think it's a very simple answer, and it's something we've talked about for years and years, is that the reason gold, and I'm using gold and only gold right now, the reason gold has been suppressed for all these years, I mean, literally go back to the 1960s, the London gold pool. There's been a concerted effort by Western governments to suppress the price of gold. And the simple reason is gold is the anti-dollar. Gold is the number one direct competitor to the dollar. I mean, if we were talking right now and gold was $24,000 an ounce instead of $2,400 an ounce, that would be indicative of a collapse in confidence. So what they've done is they've tried to prop the dollar up by knocking the crap out of gold, whenever they get a chance with paper, so that they can point at the price of gold and see, gold bad, dollar good. Now, why is silver more heavily suppressed than gold? And Andy touched on it, because it's such a minuscule market. I mean, total global production, even at today's prices, only amounts to about $20 billion a year. And I mean, you got individuals now that could drop $20 billion out of their pocket and not miss it. So it's an absolute minuscule market. But if you saw silver run to $50, $75, $100, 200, 300, 500, if you saw silver blowing out to the upside, that's going to drag gold along. That's going to light a fire under gold and thus destroy confidence in fiat currency. So the reason silver is the biggest redheaded stepchild in the history of financial markets is because it is the fuse to light gold on fire, and gold is kryptonite to Western fiat currencies.
How about gold? Also, people are asking when they get into this, what's their split? Did they buy 50-50 gold and silver? Did they go heavier on silver to capture this wave? What would you suggest to the audience members? I'll start with you, Andy, as you're on the screen, and then we'll ask.
Well, I mean, gold's the only tier one asset in the world. It's important. Silver is the value of a generation. And if you play the silver to gold ratio, which I think is highly probable that we see it revise, I mean, it's coming out of the ground at 7-1 or less, and it's priced at 80-1. It's the trade of a generation. From a pure standpoint of potential and undervaluation, it's silver. And I would not ignore silver in terms of the way the central banks are accumulating it. But I will tell you that in the end, I think a lot of your assets we would prefer to convert silver to gold when that ratio corrects, because it is the only other tier one asset. And let's be honest, Bill could put $1 million worth of gold in his backpack and get on his horse and go for a ride. $1 million worth of silver, the horse would be pulling a trailer that would weigh 1,500, 2,000 pounds. So, this is the main problem, logistics. But silver for value, in the end, I have a hard time believing that gold would not be the place to have the majority of your assets, but not yet. Silver provides probably the most undervalued or best trade, silver to gold, of my career for sure.
I'll put some numbers on it. My recommendation now for the last probably 3 years, 4 years has been, if you're going to do a mix between gold and silver, you should be at least 70% silver. And the idea being, when all is said and done, you're going to want to be at least 70% gold. The ratio's at 80 right now. If that ratio comes down to 40, that means that silver outperformed gold 2-1. So if you bought all silver, ignoring taxes, if you bought all silver and you swapped out at 40-1 from where we are at 80-1, you would be able to buy 2 gold ounces for every 1 gold ounce that you could buy today. So you want to be heavier in silver. And if you want to be 100% in silver or, 95% in silver, I don't have a problem with that. But don't, on the way out, don't get cute. If we see, say, 50, 55-1, you swap out to whatever you want to ultimately get to, swap out a quarter tranche. And then at 40-1, swap out another quarter tranche. And if we get down to 25, 30-1, swap the rest of it out. And now you're at 70-30 gold or 80-20 gold, whatever. But yes, you want to be, when all is said and done, you want to be heavier in gold than silver, because gold is, the only thing gold is money. And silver obviously is money. It's industrial, medicinal, solar, et cetera, et cetera. So I think trading the ratio just makes all the sense in the world, because the ratio was created by what we were talking about before. It was created by the fact that they're suppressing silver as hard as they are. They've suppressed it harder than gold because they can't let it go higher without gold taking notice and then lighting up the whole system. So take advantage of their suppression to get to an 80-1 ratio and write it down to 40 or 50 and end up with more gold ounces than if you just bought it outright today.
And 40-1 is roughly the 200-year average price-wise, as Bill calls it, man's ratio. God's ratio, as he calls it right now, and appropriate to call it that, is about 7-1. That's what it's coming out of the ground at. So at 40-1, which would be an average of two centuries roughly, you're still 6 times above what it's coming out of the ground with. So he's saying pigs get fed, hogs get slaughtered. When you get anywhere near that point, trade some of it. And I think it is the best, especially if you're in an IRA, because now you have no storage issues for the silver and the ability to, no tax issues when you make the trade. So, but yeah, I consider it to be the trade of my career too.
India's silver imports have soared up 654-fold compared to last year, taking advantage of artificially low prices due to market manipulation. These nations are buying up physical silver, and that demand is likely to tighten supply significantly. With the Big Four and Big Eight banks holding unprecedented short positions in silver, any failure to deliver could ignite a massive short covering rally that propels silver prices into uncharted territory. Let's break it down. Silver could be one of the greatest value investments of this generation. As Schectman points out, silver is priced at 80-1 against gold, but it's being mined at a ratio closer to 7-1. This disparity is unsustainable. If silver were to correct closer to its historical average, investors could see a once-in-a-lifetime opportunity to trade silver for gold at a favorable ratio. So, what should you do? Schectman advises investors to consider going 70% silver and 30% gold in their portfolios, with a strategy to trade back into gold when the silver-to-gold ratio corrects. This approach allows you to capture the explosive upside in silver while ultimately holding a more stable asset, gold, when the dust settles. In summary, the silver market is set for a massive shakeup. With potential failure to deliver events looming and a huge short covering squeeze on the horizon, silver could quickly move from its current price to all-time highs. And as silver rises, gold is poised to follow, potentially breaking free from the decades-long suppression by central banks. For investors, this is more than just a forecast. It's a call to action. Precious metals, particularly silver, are undervalued and suppressed. But as these forces unravel, those positioned correctly could reap tremendous rewards. Stay tuned, investors, because these market dynamics are set to change the financial landscape as we know it. Don't get caught flat-footed. The time to act is now.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
The silver market, analysts are drawing parallels between a potential silver cartel and OPEC's influence on oil prices. Speculation is rising that a silver cartel involving China, Mexico, and Chile could drive significant price movements, reminiscent of oil market dynamics. In a strategic move, a Chinese silver trading powerhouse is expanding its operations in Singapore. The commercial arm of the private smelter, Henan Jinli Gold and Lead Group Co., aims to capitalize on bullish sentiment in metals like copper and aluminum. The division, which handled half of China's silver exports last year, plans to grow its trading team in Singapore from 4 to up to 20 professionals, reflecting the intensifying competition for talent in this sector. The metals market is undergoing a transformation driven by increased demand from renewable energy projects and advancements in artificial intelligence. This shift is attracting major energy traders to metals, traditionally dominated by giants such as Glencore and Trafigura. Jinli's Hong Kong subsidiary played a pivotal role last year, selling 2,000 tons of silver ingots to top bullion banks like JP Chase. Market watchers are intrigued by the potential for a silver cartel. Comments from influential figures could have outsized impacts on prices, as seen in the oil market with OPEC. For example,
guy who's the director of the silver cartel, and I don't know what they're going to call it, but then
if Mexico and Chile announced a 10% reduction in silver output, prices could surge, echoing past reactions in the oil sector. Regulatory uncertainties in Mexico have already caused a 60% decline in foreign investment in its mining industry. This trend suggests future output reductions, adding another layer of complexity to the silver market. Meanwhile, the expansion of solar farms in India and China is bolstering silver demand despite technological advancements in solar efficiency. Innovations in photovoltaic cells have increased efficiency, but also heightened the overall demand for silver. Despite strong fundamentals, silver prices could face downward pressure due to current market sentiment and selling activities. Notably, Shanghai traders are adjusting their positions, impacting the market outlook. Critics argue that Western media is neglecting significant financial stories, such as the US dollar's declining role in global trade and as a reserve currency. The US dollar's usage in global trade is nearing a 50% threshold, a dramatic shift not widely reported in mainstream outlets.
and an extension of Five Eyes is Western Europe. So Western Europe, United Kingdom, United States, Canada, Australia, and New Zealand don't talk much about the unit. They don't talk much about the BRICS. Okay, they've got controlled media. So the West, the primary nations in the West have controlled media. They don't talk much about gold and silver. They don't talk at all about BRICS. They don't talk about the unit. They don't talk about anything that's really important in global finance. They don't talk about the dollar losing its status okay, we're getting close to 50% usage now in global trade for the dollar. We're rapidly declining for Forex reserves that are US Treasury based. These are not stories that are in the Wall Street Journal, the New York Times, the Washington Post, or LA Times. The United States is not well informed. And I'm not really too surprised about the Rick Rule conference, because they're probably very focused on mining stocks, and they're focused on available gold and silver coin dealers, not dealers so much as where does one buy gold and silver coins, and what is the safest way for making payments. I don't find that Americans and especially Europeans, because they've gone back into the dark ages since the sanctions. I don't find that Americans are really astute in seeing what's coming down the road. Because, I'm not making this up. Most Americans don't know much of anything about the dollar. They don't know that it's being used in global trade. They don't know that treasury bonds are held in foreign central banks. I've asked some people who visit me and people I meet at like sports bars, I ask them dollar questions. They don't know anything about anything. I mean, they are dangerously ignorant about the dollar and global matters of finance. I could recite a lot of different questions, and I had my favorite. And actually, since that illicit lockdown in 2020, I haven't gone to the sports bars much. What I've been doing, this is just a personal note, but it's really college football. I go on a Saturday, and I meet a couple friends, maybe if I'm lucky, and I get assaulted by attractive young women, and I watch a couple of games.
There's a concerning lack of awareness among Americans regarding global financial matters, particularly the status of the US dollar. This ignorance extends to the intricate details of international trade and currency reserves. In the midst of these developments, the video calls on viewers to consider their own investment strategies. Will the manipulation of gold and silver prices end, leading to soaring values? The speaker shares insights on potential selling points for silver, emphasizing the importance of seizing profit opportunities. As the market evolves, the video encourages viewers to stay informed, share their predictions, and engage in discussions about the...
Comes out with a statement, I'm talking like 18 months down the road, Chris. Comes out with a statement like, well, we're thinking about Mexico and Chile reducing by 10% their silver output. And the silver price goes up $2. If it happened for oil with respect to OPEC, it could happen with silver with respect to a new silver cartel. This is potentially dynamite for pushing up the silver price. Imagine they say, well, okay, and you know, Mexico is all over the news. They're talking about, and the Supreme Court has got to settle on this. It's a restriction on foreign direct investment to the mining industry. And it's not approved, but just having it floated and potential, it's brought about a 60% decline in foreign investment in Mexican mines. Okay. So they're going to see a reduction in the future months for output. Okay, I'm telling you, this silver cartel is going to be a big item. And I'm watching it, and there's not much news with the silver price. And India and China are really angry. India and China are building out solar farms. In the United States, it's largely California. And I've had two, I'll tell you, my consult calls are very valuable. I had an Ohio client and I had a Virginia client, each one reporting rather expansive solar farms in those states, Ohio and Virginia, called PV, photovoltaic, PV. The PV cell is had 2 or 3 rather impressive developments, improvements in the last couple of years, maybe 3 or 4 years. And what's really remarkable, Chris, is it does not bring about less silver. It brings about more efficiency and the motivation to do more silver, to do more panels, more volume, maybe a little bit less silver within, like they're calling it a square meter. How much silver per square meter, how many watts is produced per meter, square meter. It's really quite interesting, but the developments are not bringing...
Example.